Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, cyber hackers ask for a $70 million ransom for a group of U.S. companies. President Joe Biden just a few hours ago signed an executive order clamping down on big tech. And how are stocks going to do heading into the second half of 2021? That and more tonight, all on Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I hope your week went well. I'm Andre Laborde. Our goal is bringing Wall Street to your street for today, Friday, July the 9th, 2021, and get you ready for the week ahead. We have a great show for you this evening. With the first half of the year in the rearview mirror, maybe you're wondering how the possibility of rebalancing your portfolio or your investments for the remaining months of this year to your liking. Well, tonight, we'll be talking with wealth advisor Jim Spiro. Jim is managing director at Morgan Stanley. He's the head principal of the Spiro Group, and Barron's Magazine has consistently named Jim one of the top 100 advisors in the country. And he's going to be with us tonight in just a minute. But first, how did the markets do this week? Well, the Dow Jones Industrial Average ended the week at 34,869. That was up 447 points for the day and up about 0.25% for the week. The S&P 500 closed today at 4,369, up 48 points for the day and up 0.4 point for the week. And finally, the NASDAQ. They finished the week at 14,701, up 142 points for the day and up almost 0.4 point for the week. The Dow Jones, the S&P 500, and the NASDAQ had record closes for the week, and that was beating last week's record high. And the NASDAQ 100 was higher for the 8th straight week. And Bitcoin had a good day today as well. They rose to $33,400, up $550 for the day. And this week, analyst firm Wedbush has initiated a buy on General Motors with a new price target at $85. Oppenheimer has raised the credit card company Visa to an outperform buy with a new price target at $281 a share. And Morgan Stanley has named American Express its top credit card pick, raising its price target to a $171 a share. Well, hopefully for the first half of 2021, you ended up with your investments in a positive mode. But if not, don't worry. There's the second half of 2021 that we're now into, and it's just begun. Jim Spiro has been advising clients for over 35 years as a managing director at Morgan Stanley and principal of the Spiro Group. He's been successful as a wealth advisor, and he's way ahead of his peers. Hi, Jim. Welcome to Wall Street Wrap-Up.
Hey, it's good to be here with you, Andre. Thanks for having me aboard.
How does the second half of 2021 look when it comes to the economy?
Well, I think, look, a lot of this is, I don't know what the numbers are these days. Used to say years ago the $64,000 question. I guess you have to scale it up for inflation, so maybe now it's a $64 trillion question. But I think it's a large question mark, and I think it hinges on a couple of things. One, additional take-up in vaccinations. So far, a large percentage of the population has been vaccinated, but the president obviously wants more. Second, whether one or a number of these variants proves to be elusive with respect to vaccinations and causes problems down the road. Three, whether the enormous amount of monetary and fiscal stimulus that the Federal Reserve and the federal government have provided to the economy continue to be needed, and if so, do they become excessive? So what you're seeing right now is we've had a very good first 6 months. I think a lot of this is a play that still needs to be written. My instinct is that you'll see the economy continuing to improve. It's lagged the stock market, but that's not an uncommon trait for the stock market to precede the economy. But I think there are some potential headwinds out there, and I don't anticipate the second half to be as smooth as the first half has been, nor as robust. Obviously, I could be proven wrong, but that would surprise me a great deal, Andre.
And that's interesting what you bring up also, because there's a couple of things I want to follow up with that. One is that there's so much liquidity being pushed into the market, and I've heard numbers, and you correct me if I'm wrong, something like $3 trillion globally is sitting on the sidelines, of which about 2 trillion of that three is right here in the United States, ready to be put somewhere, whether it be put in the stock market, whether it be put in bonds or whatever. So that's sitting in cash reserves. And that's going to be continuing. Is that some of the good things ahead, or do you think that's one of the headwinds?
Oh no, that's a definite potential plus. The only concern is if and when it becomes excessive, and neither may materialize. But I don't know what the numbers are. They're so vast and they're constantly changing. But I do know that there's more liquidity, certainly in the marketplace as a percentage of GDP, purely in an absolute sense, just the number of dollars, than at any point in my certainly my 37-year career. The banks are flush with money. A lot of that money has not been demanded in the form of loans. So a lot of it is simply being recirculated back to the central bank. The Federal Reserve has more money parked there than it ever has. Mutual funds have not an insubstantial amount of firepower. And as you said, a lot of the American public, notwithstanding the terrible human cost, the incalculable cost of what we've gone through, really from a financial standpoint, a lot of the American public is in pretty good shape, arguably in better shape than it was before the pandemic. I can't quantify the numbers with any degree of precision, but I can tell you the amount of liquidity in the marketplace is more by a substantial amount than any time I've seen in 37 years.
I understand. And it's interesting. We've had economists on the show in the past, and it's that they've given different thoughts of whether or not this inflation, this money that's being brought out, is inflation is temporary, transitory, or is this inflation more here to stay if it's not stopped? Do you see that the Federal Reserve is going to continue? I mean, you've had 35 years of experience in this with the Federal Reserve. Do you think they're going to actually continue low interest rates as they have now, at least till 2023, as they originally said, or do you think that they're going to have to start boosting it up prior to that, to 2023?
Well, the Federal Reserve, as it always is somewhat non-committal. I think the phraseology they like to use is that they are data dependent, and I think they probably are. Their initial conjecture, and it was a fairly uniform response amongst all the members of the Federal Open Market Committee, the folks who vote on monetary policy, was that certainly till the end of 2023, interest rates would stay in this 0% framework. Now, the numbers have gotten better more rapidly and more substantially than they anticipated. So you're starting to see some folks fall off the wagon, so to speak, and talk about raising it, if not in early 23, even in late 22. I wouldn't be surprised, unless things take a real turn south, I wouldn't be surprised to see one hike in 22, but that's tough to anticipate. But perhaps the whole time schedule is being moved up. But I do think it's likely, particularly if we stay on the current course, which is more robust economic growth, more robust job growth, and an enormously robust set of financial markets. I do think it's more likely that you will see the time frame, if not accelerated as a behavioral matter, certainly as a rhetorical matter. I do think you will begin to see that. We saw that at the last Fed meeting that took place, whatever it was, a week ago, that more and more people are starting to offer not a very powerful and vigorous dissent because they really don't want to oppose the chairman, but I think they're starting to express concerns that the level of monetary stimulus in the marketplace, if it isn't, it's about to become excessive. Yes, I do, Andre.
Yeah. Do you think like a canary in the coal mine would be that they're right now they're buying $120 billion, that's billion with a B, $120 billion of bonds, 80 billion in treasuries, 40 billion in corporate bonds per month. Do you think they'll stop that first before they start raising rates, which will sort of like give a head, a head start for those who'll know next comes the interest rates?
Well, actually, the way you first raised the question, I was kind of caught off guard. You asked me if I thought like a canary in the coal mine, and I'm not sure how a canary in the coal mine thinks. But leaving that aside, uh, the Fed for the last, I don't know what it is, year and a quarter has been purchasing, as you say, $120 billion of securities a month. It's $40 billion of mortgage-backed securities and $80 billion of treasuries. I would think that the first thing they would do is lighten up on the mortgage-backed component. I think it's difficult with housing prices at all-time highs, with people getting in bidding wars, with asking prices frequently being topped, and with a dearth of supply. I think it's hard to make the case that the housing industry needs a subsidy in the form of $40 billion of mortgage-backed securities purchased a month. So I think that would go away first. Then I think you might see a tapering of the treasuries, and then I think you might see that supplemented uh, by phraseology from the Fed chairman that we're getting ready to perhaps make a more vigorous move, which would be adjusting the federal funds rate. Or he may not have to make that statement. It may simply be the reduction in purchases will signal to the marketplace. Once that's cleaned up, the next move will be the federal funds rate.
I see. Jim, what does it mean this week? The treasuries have 1 year, 5 year, 10 year, 30 year type of treasuries, but the 10 year treasuries is pretty much a benchmark of what they look at. And this past week right here, it's been hovering low. The yield has been hovering low to about 1.3%, which means if the yield is low, that means more people are buying treasuries. If people are buying treasuries, what is that saying about equities?
Well, I think it's saying there are a couple of things that it could say, and it could be a combination of these things. And I'm not trying to be evasive, but you simply have no way of getting in the minds of the collective investment community, as it were. But here are some things in the aggregate that I think it is likely saying. Number one, it's, I think, likely saying that to some extent, the level of economic growth we're seeing and stock market run up we're seeing has to begin to cool off. It's not Jack and the Beanstalk. It doesn't go this way. The market was up really last year, almost 18, 19% as measured by the S&P. As you and I speak, it's up about another 15, 16, 17 through the first half of the year. So that's probably got to taper. I think the other thing it says is that more of the institutional investment community is accepting Chairman Powell's argument that the inflation will be largely transitory. That still is yet to be proven or unproven. And I think the last thing it's saying certainly couldn't be disputed is that U.S. interest rates, notwithstanding how extraordinarily low they are, might still be the best house in a crummy neighborhood. There, I think, is $17 trillion worth of debt globally that's still at negative yields. Vast swaths of Europe are at negative yields. All of Japan is at zero or negative yields. So when you look at the 10-year U.S. Treasury and say, geez, it's at 1.25 or 1.5, somewhere in there, that's a lousy return. It is a lousy return, except when you say in Japan it's zero, in Germany it's slightly negative. So as I say, maybe it's the best house in a bad neighborhood.
Do you think also, is like what we talked about earlier, is that there's so much money on the sidelines and cash reserves that whether it be 2 trillion, 3 trillion, or whatever that number is, that they're looking to park it somewhere. So normally the treasuries are so-called safe investments, so they're using that to park it in there. Because normally, Jim, I'm usually thinking, and correct me if I'm wrong, is that normally when money goes into treasuries, it's more of a fear of what the market is going to be doing, the stock market. But in this case, I'm just curious as whether or not they're just looking at a place to park their money.
Well, I think again, you've touched on various components of the answer. It's all in that language you chose. Different pieces, I think, in the aggregate will summarize the answer. I think there is some concern that, as I said, we could get a variant that isn't offset by the efficacy of the vaccinations. I think there are always geopolitical concerns. You see China cracking down on Taiwan, China, or talking about it, certainly cracking down on Hong Kong. Russia continues to be a thorn in our side. You see some dysfunction in Washington. I guess we've grown used to that, regardless of which administration is in power. Mm-hmm. So I think there is always some flight to safety component to the bid on the treasuries. But I think some of the strength in the treasury bid, as I told you, is because it's still the best in a bad neighborhood, and because there's really no institution. I'm not talking about a hedge fund that's swinging for the seats, but there's really no institution, a fireman's fund, a policeman's fund, a large insurance company that's going to put 100% of its money in equities.
You brought up a good point about China and the Chinese stocks, and maybe not one. Now I'm thinking of this past week. There was a company called Didi that originally was an IPO not that long ago, just a few days ago. That's been stopped now by the Chinese government, but not that just particular stock. But let's just talk about sectors. When it comes to like Chinese stocks, do you think that that investors are going to be very much more weary now, I said weary, but maybe I should use an L, leery, about whether or not to invest in companies that are Chinese stocks because of the fact that the CCP, the Chi-Coms, are the ones in charge of it?
Well, I think that people need to understand that China is, a very different form of governance from the U.S. People talk about how the U.S. is turning more and more dictatorial, and we can have that discussion separately. But China is an autocracy; it's a dictatorship. However, whatever word you want to apply to it, and as a consequence, I think people should look at China in a couple of ways. One, they should look at it as certainly having the potential for enormous growth. It's already exhibited that over the last 30, 40 years since Deng Xiaoping opened some things up. And it's continuing to exhibit enormous growth. And look, you have 1.3 billion people, give or take. 1.3 billion people can make a lot of stuff and they can buy a lot of stuff. So that's a big market. That's 4 times the US. But you should not gainsay the fact, and I think people shouldn't underestimate the fact that China is a centrally controlled economy. It does not have free markets the way the US has. However free the US markets used to be, more so than they are today. Today, they're still far more free than the Chinese markets are. And I think that should be a meaningful component of a person's decision in choosing whether or not to invest in China.
Jim, when you have your clients talk to you about where they should park their money, put their money, and I know each person may be different, whether it be for short term, long term, or what is considered retirement in how many years down the line. You have domestic stocks, you've got foreign stocks, and part of that is, could be considered these Chinese stocks that we were talking about or European. What type of allocation are you talking about? Do you have an allocation that you usually advise that X amount should be in domestic companies and another X amount should be foreign, or are they all these days one big basket of stocks?
No, there definitely isn't a basket. I think there's a sort of a very, very generic framework that we'll sort of put out on the table, and then it has to be tweaked in almost every different situation. But generally, Andre, uh, we like to have a percentage of clients' assets in equities that's commensurate with the individual's age, risk tolerance, net worth, predilection for growth versus income, all that kind of stuff. Uh, and then within that framework, we generally like to have somewhere around 80% of the equity slice in domestic and the other 20% overseas. The overseas could be developed markets, it could be developing markets. That varies on a case by case basis. And then with respect to the fixed income side, generally, as a person ages, we dial down the equity side and increase the fixed income side. But there have to be exceptions to that. And over the last couple of years, we have seen a lot of exceptions to that because interest rates are so low that for a lot of people, they simply can't meet their retirement goals, their lifestyle goals, by having the slice of money that they would normally like to have in fixed income because the returns simply aren't there. So they either have to tighten the belt and enjoy a less bounteous style of life, seek return elsewhere, or work harder and work longer. There are three rather unpalatable choices, but you can't make more than 100 cents out of a dollar. So that's a rough guideline: 80% domestic, 20% overseas, and then the balance of the portfolio, and it could be anywhere from 0 to 10 for a very young person to in excess of 50% for an elderly person.
We're talking right now with Jim Spiro. If you're just joining us, we're so glad to have him, and we've got more to talk about in just a moment. Been talking with Jim Spiro, a managing director at Morgan Stanley. Happy to have him. Jim, welcome back. We were talking about a number of different areas. Even when right before going to a break, we were talking about the allocation of maybe an 80-20 or whatever between domestic stocks to foreign stocks and such. And we're also talking about Chinese stocks. I know I get asked quite a bit, and I am in nowhere in your caliber when it comes to clients and talking. People ask me, Andre, are you investing in Bitcoin? Are you going into cryptocurrency? You must be asked that quite a bit with the amount of clients that you get or people you meet on the street. What is your feelings about the cryptocurrency craze?
I get that question routinely, and I have a standard answer that really isn't just applicable to Bitcoin. And it served me well over many, many years, and I intend to stick with it. And that is, Andre, that I don't invest in anything, and I don't advocate investing in anything on someone's behalf. He or she is free to overrule me, but if people seek my advice, I don't invest in anything that I don't understand. And the truth is that I've talked to a number of people about cryptocurrencies. You listed a number of them. I've tried to do some reading. I haven't made it a research project. And I have yet to get what I would call a lucid, persuasive argument on behalf of owning cryptocurrencies. That's not to say that one doesn't exist. That's not to say that one hasn't been furnished to me and I simply didn't fathom it. But it is to say that if one were furnished to me, I'm unaware of it, and I certainly haven't reached that conclusion myself. So there are two arguments in favor of cryptocurrencies. One is that it serves as an alternative form of currency, and that's fairly easy for me in my own mind to rule out. And we can get into that if you wish. And the other is that it serves as a useful investment. It may be, but I simply don't understand it. And what I don't understand, I don't invest in.
I completely concur on that one, my friend. Got a question also. Do you think also, I mean, this past week we've had cyber attacks, as we've had in previous months. Do you think it's just a matter of time before Congress starts to put more regulatory rules on cryptocurrencies, even to use, not to use?
I wouldn't be surprised, Andre. It's tough to anticipate what 535 people are going to do, but I wouldn't be surprised. Most of what I read about cryptocurrency seems to suggest, or what I've read is not a suggestion, it's a statement of fact, that they seem to have some usage to date in nefarious activities. So I would think that Congress would look askance at that.
Jim, 6 months ago, I didn't know what a meme stock was. M-E-M-E, a meme stock. Today, it's all talked about, I mean, stocks like GameStop or AMC. When it comes to fundamentals of usually of deciding whether or not an investment should be made in a company, sometimes these meme stocks are those fundamentals are being thrown out the window. What are your thoughts on that?
Well, my thoughts are twofold. Number one, you beat me by a month. I didn't know what a meme stock was until February.
Okay.
I finally decided to look up what a meme stock was.
Yeah.
I guess my thought is that, and it's not a dissimilar answer to the cryptocurrency answer. I have found over 37 years, particularly over the last 25 or so, I had to learn a couple of hard lessons, that there are plenty of opportunities for me personally and on my client's behalf to try to make money in manners that I not only understand, but that avoid structural complexities, high costs, high levels of taxation, lots of paperwork, confusion, and so forth. Broad-based index funds have served me quite nicely. Dollar cost averaging has served me quite nicely. Laddered bond portfolios have served me quite nicely. All concepts that didn't originate with me, that have been around for years, that indisputably work over long periods of time, that are extremely boring, and most people don't want to pursue them. But I find that that's a better road for me to go down than to try to get involved in chat rooms and social media and trying to hop on board something and pop it for a quick buck. There isn't anything wrong with that. People do it all the time, but they should understand that's not investing, that's speculating. And I really don't have a great deal of interest in doing that because, as I say, I think there are ample opportunities for me to make a nice return without all the consternation. And at the end of the day, I'm more interested in the return and making money than the excitement along the way. And I find choosing things like broad-based index funds and dollar cost averaging, and we listed a few others, they're sufficiently boring that it may seem counterintuitive, but as a consequence, people stick with them over the long term, and it's easier to make somebody into an investor using that route than it is to make somebody into an investor who wants to pop a stock for a buck. So meme stocks falls into the same category for me as cryptocurrencies.
Jim, with time, I've got maybe about a minute left. I got one more question. I've got many questions, but one more for this particular time. With the second half of 2021 now, we're involved in it. Where are you steering your clients when it comes to sectors? And when I say that, I mean, do you think energy is going to be good? Do you think financials are going to be good? How about technology? I mean, I'm just throwing things out, but what are you talking to your clients about?
It's a large client base. It's a loyal one, and it's taken years and years to cultivate it and to get it to sort of come on board with my line of thinking. And the point is, that I found over the last 6 to 12 months, never mind 37 years, that technology has been hot for a while and then it got out of favor. Now it's hot again. Energy, same. Financial, same. So what I do, Andre, is frankly say, look, I'm happy with things like a total market index in S&P 500, a total overseas index. I take a lot of the guesswork out of it. Because if any one or two of these sectors participates very, very robustly, there's going to be not an insubstantial amount of representation in something like the S&P 500. Those sectors are meaningfully subsumed by a broad-based index. So I try to tell people, and it's quite true, and I hope I can pass this along to your viewers, that broad-based index fund investing, simple, sticking with it, dollar cost averaging is one of the rare times in life where the easy thing is actually the right thing to do. So I'm agnostic as to which sector or which individual company. I really don't spend a lot of time on that. I spend more time looking at what's going on in the macro economy, more time trying to get an understanding of what might come out of Washington, more time focusing on geopolitical things, and realize that broad-based investing actually will get the job done quite effectively, more cheaply and more simply without the consternation. So that's my answer to your question.
Jim, that's great, which is a great way to end it on this time, but I hope you come back.
So thanks, Andre.
Thanks a lot to my friend Jim Spiro. Well, if you've got a question about finance or a comment about the show, love to hear from you. You can write us at andre@wallstreetwrapup.info. Keep it pithy or concise. We'd be glad to answer your questions. And now for a look ahead for next week. But first, what's soft drink Pepsi? How did soft drink Pepsi get its name? We'll have the answer in just a minute. How did the soft drink Pepsi get its name? Well, from the digestive enzyme pepsin. And finally, well, we've all been locked up the last year and confined to our homes due to COVID. Well, there's a strange, unknown scientific phenomena that when clothing is stored in a closet and not used, it tends to shrink. Now, oddly, this phenomena only occurs not in the length of the clothing, but for some reason, unknown reason, only in the waistline, and it becomes tighter. Retailers are poised to see a robust rebound in sales in the second half of 2021, driven by less markdown activity and a jump in shopper traffic, analysts have reported this past Monday. And L Brands will be changing their name to Bath and Body Works and splitting Victoria's Secrets to a separate company. This separation is going to be occurring on August the 2nd. Well, next week, we've got a great show for you. You may not want to miss. There's not one of us in the sound of my voice who's not seen eaten at McDonald's. Ed Resnick, former CEO and president of McDonald's, and now he's the chairman of the board of Fats Brands with companies like Johnny Rockets and Bonanza and Ponderosa, Fat Burgers, or Buffalo World Famous Wings, will be my guest. How has commodity prices hurt his business, or has stimulus spending made it more difficult in hiring? Next week, the former CEO and president of McDonald's, Ed Resnick, will be on our show. And that's our show, and hope you've enjoyed it for Friday, July the 9th, 2021. And thank you, and thanks also to Jim Spiro for being our guest tonight, and my thanks to you for allowing us into your homes this evening. Remember, you can always follow us on Facebook and WYES.org. Have a great weekend and an even better week ahead. I'll see you next week for Wall Street Wrap Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.